Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching IndianOpen. Let's go straight to the headlines at this hour. Infosys and TCS kickstart the fourth quarter earnings season today. Steady deal wins expected for both tech giants, but margin pressures would remain. Jet Airways suspends international operations after lessors ground another 10 planes over non-payment of dues. First phase of the Lok Sabha poll saw voter turnout ranging between 50 to 80% across 91 constituencies in 20 states. And the Supreme Court will deliver its verdict on the legality of the electoral bonds at 10:30 a.m. today. Ride-hailing app Uber files for an initial public offering in the US. Morgan Stanley and Goldman Sachs are the lead managers. It's raining IPOs, I must say, in the US. Uber is coming. Levi's has filed for an IPO as well. So a bunch of very known names coming out with initial public offerings, taking advantage of the market situation there. Speaking of market situation there, let's start off with the world setup. No big news flow coming in terms of international trade or otherwise. So it was a quiet day for the markets as well. Ahead of the earnings season, I think the US markets were just biding the time. So very, very flat for all the three key indices. Europe wasn't dramatically different either. And if you look at the Asian screen today as well, there is nothing too large happening. Nikkei, 0.6% might seem high, but it usually is an index which has moves of 1.5%, 2% as well. Shanghai flattish, Hang Seng about flat, SGX Nifty indicating a very, very flat start. So I doubt that we have a dramatic open at our hands. The question is, can we build on from where we start off on the second day of the elections getting underway? Well, it was a day of low volumes, though, you must say, relatively, at least on the cash side, because yesterday, while we were flat, and F&O volumes would have been slightly higher because it was the options expiry, the cash market volumes were very, very low. So no clear cues coming in from trade yesterday. Anyways, most of the experts are now shying away from taking trades on the Nifty or the Sensex or the Nifty Bank for that matter as well. Almost everybody seems to be betting on individual stocks. Volatility though continued to remain high. India VIX shy of 21, but in and around those lanes and remains at those 5-month highs. So no change out there. And even if you look at what happened to the open interest or the OIs for the series at large, some traction in terms of open interest for the Nifty Bank that came off quite a bit, but otherwise very, very ordinary. And I think a very, very broad range being bet on by option traders right now for the series, because if you look at the 12,000 call and the 11,000 put, those remain the most active with the highest OI concentrated there, and that's very large. I know this is the, well, not the start of the series, but near about the start. It's the first half of the series, but because of the volatility that the markets might get due to the elections, I think traders are hedging their bets. So at extreme ends for the range for the index continues even now. There are some build-ups in certain other strikes, as there would be the case, but the larger betting seems to be between 11,000 and 12,000. Flows were okay. The DIs were very, very soft. We've been speaking about how they have been consistent sellers. So now FI is putting in positive flows has ceased to be news. That almost seems to be a given. The key is after 13,000 crores in March and about 1,400, 1,500 crores in the month of April, DIIs are not coming back. They are consistent sellers in the market, and that number continues to remain negative. Lastly, something that would be on top of mind of most investors is what's happening to crude. A bit of a retreat from the 5-month highs for crude. VIX stays elevated, crude doesn't. It's hovering around that 70, 71 mark, but came off in the session yesterday. The US stockpiles, the number has gone up quite considerably. However, I must say that a lot of people would say that while the US stockpiles might move up, it's essentially the moves from OPEC and OPEC Plus which might drive crude prices. Vladimir Putin saying that talking in favor or giving out statements which might actually bring down crude prices is a positive. But let's wait and watch. For now, the prices remain in that elevated range, just retreating a little bit in trade yesterday. However, what is it that one should watch out for in the session today? Well, a bunch of small stocks as well, and we'll talk about them during the course of the day. But largely, first, TCS as well as Infosys, both the companies come out with numbers. So you would watch out for these two IT majors during the course of the day. We'll talk at length to traders as trading experts as well as investing experts about what to do if you have investments or if you want to trade both of these names. So these are important. Also important is Sterlite Tech. The fundraising plans, they are going to consider raising funds via NCDs and equity on April 23rd. I doubt they would contemplate doing an equity raise at a point of time when the stock has gone down by 50%. Normally a fundraising piece wouldn't make it to my list of the top stocks to monitor, but because this stock has been beaten down so badly, I think, and has been so volatile in the last few days, announcements around the stock remain important. They have hired 3 or 4 very senior people as well. Let's wait and watch if there is a reaction thereof. Jet Airways, as the headline stated, 10 more planes grounded due to non-payment of dues. Operations to East, Northeastern markets suspended, is sources to PTI, and of course the international operations have also been suspended. So do watch out for that. And lastly, amongst a lot of other stocks that we'll be focusing on, Avenue Supermarts, there is a downgrade from Morgan Stanley, so that is one we'll focus on. And there's a small, tiny tune called Foods and Inns, wherein Dirav Investments, where there's a Radhakishan Damani company, has bought some stakes, so that's the other one that could be in focus today. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we believe we should bring to you. Can't be bigger than IT, isn't it? At least today, when both the giants come out with numbers. So Agam Vakil will tell us what the analysts are expecting from TCS and Infosys and the IT sector as a whole. Next, the transfer of Sun Pharma's distribution business may lead to a one-time hit on its fourth quarter earnings. Aman Kapadia will tell us why. There is a change in growth dynamics amongst two-wheeler makers. Yatin Mota will put that into perspective. And railway component makers may get a GST relief. Nikunjori will tell us why. However, I don't remember the last time this happened. 2 of the country's largest technology companies, which is TCS and Infosys, will kickstart the fourth quarter earnings season together today. But before we get into specifics, what do analysts expect from the IT sector at large? Agam Vakil Johnson with a snapshot. Agam, good morning. I don't know if you also remember the last time both these companies came out on the same day. Yeah. But before we get to that, what's expected from the sector?
It's going to be a mixed quarter. There's no doubt about that. It's a seasonally weak one. We all know this is the time when clients, take a moment to think about the budgets for the upcoming year. So we aren't expecting any fireworks. And of course, as far as your growth is concerned, overall, now if you take an aggregate of the top 5 companies by market capitalization, which means TCS, Infosys, Wipro, HCL Technologies, and TechMind, the Nifty 50 companies, the Nifty 50 IT companies, well, you see that growth would come up to around 0.9%. But this is a lot to do with the temperance that we've seen, perhaps some of the companies such as Wipro and HCL Tech, because we're actually expecting steadier growth when it comes to TCS, not necessarily as much for Infosys, but that is of course on rupee terms. EBIT, however, is expected to remain flat, and this is something that which could be a continuation of what we've seen in the previous quarter because of a lot of factors, and consequently profits could rise just as much as 0.3% quarter on quarter. So among the 3 factors that are most important to the sector and that may actually play out is that we've seen a steady flow of deals, and hence we can expect that growth to sustain, especially for the large cap IT companies on the back of your constant currency growth. However, what could come off as a surprise, or rather is the pressure that we're seeing in operating margins, essentially on the back of challenges with respect to higher people's and contractor costs. And let's not forget, there has been a little bit of appreciation of the Indian rupee against the US dollar, so that may also play against the companies. But that's as far as your information technology sector is concerned as a whole. Let's now talk about what we can expect from the 2 giants. Well, Infosys and TCS. So in terms of revenues, and that should come up on your screen, as you can see, we're expecting very steady growth for both these companies on your top line basis. So in dollar terms, both TCS and Infosys are expecting to see an over 2% growth. And for Infosys specifically, a little higher because of the kind of investments that they have put into the company over the previous 3 to 4 quarters. Moving on to your operational, profits. we're seeing an uptick of, okay, this is your rupee revenues. All right, pardon me. We're not seeing that much in terms of your, of Infosys. But let's move on and talk about your operational profits, because that is perhaps more important. As you can see, we're not expecting too much change here. And if we can also bring up the margins, because that will give us a real picture here, there you have it. We're actually looking at a decline in operating margins for both these companies, for TCS as well as Infosys. Infosys a little more, but do remember both these companies will face some pressures when it comes to margins. And because of that, we could see some problems when it comes to your profitability. Now, TCS, of course, we're expecting a 1.5% decline in profits sequentially. But Infosys, while on a reported basis, we could see around a 9.4% increase quarter on quarter. On an adjusted basis, we're looking at a decline of 1.9%. One may ask, why is this adjustment there? That is because the company did take a write-off in terms of valuations for its assets, Panaya and Skava, which are on the block at this point in time, and they just had to devalue that, and they had taken that and put that as an effect in the income statement, which is why we're actually expecting a 9.4% uptick on a reported basis, but on an adjusted basis, we're still looking at a decline of 2% for Infosys. Now, moving on, in terms of some of the factors that we're keeping an eye on, for TCS, of course, we're going to see the digital services which will drive sales. We have seen a lot of big deals coming in for TCS over the previous few quarters. Moving on, we do have client budgets and which could mean which could be very crucial for client spending as well in the quarter, and that could give us an indication of how TCS can expect as far as FY20 is concerned. We won't get any guidance for revenues as far as TCS goes, but we are expecting the company to maintain its target of 26 to 28%, despite the fact that the company has seen some amount of pressure, just like the rest of the industry. But moving on to Infosys. Now, the total contract value, and on an average for the previous couple of quarters, it's been around $1.8 billion. And for this particular quarter, it's likely to be higher. So there certainly are a lot of tailwinds when it comes to the deal flow for Infosys. However, what will not work out for Infosys in this particular quarter is, well, its margins. We do know of the higher people's costs that we've been talking about time and again. And because of that, while we could see Infosys, well, perhaps improve on its revenue growth guidance to around anywhere between 7 to 10%. Do remember, just last quarter, it revised its guidance for this particular financial year upwards. So we could see that higher up. On the other hand, there could be a 100 basis points cut on its margins range for FY20 to around, well, 21 to 23%. So that could be a little bit of an issue as far as Infosys is concerned. But if you consider the deal momentum, well, both companies are doing very well. What can work against both these companies for this quarter is the margins pressure that was very evident in the previous quarter as well.
Well, let's wait and watch. Agam, before we wrap up, if there's one key number that you would watch out from both of these companies individually, what would that number be? Yeah,
that's easy. For Infosys, it'll be about margins guidance.
And what's the number? Acha, what's the number?
If they maintain the margins guidance, it'll be considered positive, 22 to 24%. If they maintain that, that'll be a positive. And for TCS, I'm watching out for the total contract value for this particular quarter, which could give us an idea of how FY20 is going to be.
Okay, great. Agam, thanks so much for putting that into perspective. So big numbers, two of the largest companies in India Inc. and definitely two of the largest companies in the IT space coming out with numbers post-market hours today. It promises to be an interesting evening, what with the CPI data coming out as well. So packed news flow, even post-market hours today. Sun Pharma is transferring its domestic distribution business, earlier run by promoter-owned Aditya Medisales, to a wholly owned subsidiary. This is part of its efforts to allay investor concerns over corporate governance. But this business rejig will have a one-time impact on the company's earnings in the financial year gone by. Aman Kaparia is standing by to tell us why.
In a recent announcement to the exchange, Sun Pharma said its fourth quarter earnings may take a one-time hit. This is because of the transfer of its domestic distribution business from Aditya Medisales, owned by the promoters, to a wholly owned subsidiary of Sun Pharma. While the transition will occur in the first quarter of the current financial year, its impact will be on the financial results of the previous year, or to be more precise, the fourth quarter of FY19. So why will a future transition impact its current results? Amay Chalke, research analyst at HDFC Securities, said that it is because of pending inventory at Aditya Medisales. So the way this transaction will work is, Sun Pharma has sold drugs to Aditya Medisales and that is reflected on its accounts. But at Aditya Medisales, the unsold drugs are lying as inventory. But now that the distribution business is getting transferred to Sun Pharma subsidiary, it has to take back that inventory. That will impact the fourth quarter revenue. Also, when the inventory is back on Sun Pharma's book, it must be recorded at the production cost, which will be lower than the price at which Sun Pharma sold drugs to Aditya Medisales, which means it will impact its profit. While the current figure of inventory with AML is not known, the promoter entity had an inventory of 1136 crore at the end of March 2018. We reached out to Sun Pharma to get a sense of the inventory lying at the distributor, but the spokesperson said that they have nothing to add at this point in time.
Okay, so that's the impact that could be seen on Sun Pharma. There's a wind of change out there, and there's a wind of change blowing in the Indian two-wheeler space as well. That's the next piece on First Word today. Consistent performers like Hero MotoCorp and Royal Enfield find their sales wavering. TVS Motors has also just about managed to hold on to its volumes, but Bajaj Auto, which had missed the bus over the last few years, is now playing catch-up. Yatin Mota is here for more details on that. Yatin, to be fair, Bajaj Auto has had a long way to go before it caught up with some of the bigger peers, but 2019 has been an interesting year of sorts.
Yeah, so, interesting. Yeah. So, you are also right that it's 2019 because last quarter is where, bulk of the action happened. Till about, October, we had all of the two-wheeler companies moving in tandem with their historical market shares. But post the festive season, if I may put it so, Bajaj has seen, a lot of improvement in their domestic sales versus Hero MotoCorp and TVS Motors and other two-wheeler players which have seen a decline or a flattish growth. So it's the fourth quarter of 2019, as you pointed out, is where the divergence really happened, because of which the entire FY19 market share data changed substantially for companies like Bajaj Auto. Now, if you look at the chart on your screen, which is the market share in the motorcycle segment, we are talking about the domestic motorcycle sales. Look at Hero MotoCorp, they have lost almost 1 percentage points in market share. And look at Bajaj Auto, it has increased the market share from 15.5% last financial year to FY19 end, which was at 18.4%. This is the data compiled with Siam data as well as Maybank Kiming Securities. And if you look at Honda, from doing better than Hero Moto in terms of market share gains last year, we have seen this time even Honda HMSI see a decline in market share. That makes Honda the third largest player by market share in the motorcycle segment, outpaced by Bajaj Auto's strong growth because of the Pulsar as well as the entry-level segment. So it's Bajaj Auto which is now the number 2 player in terms of market share for the motorcycle space. TVS Motors, however, has been able to defend its market share. Talking about the scooter segment, as well as the entire two-wheeler space, we have Hero MotoCorp, wherein 70 basis points market share has been lost. Bajaj Auto, despite the presence not being there in the scooter segment, has seen a over 200 basis points increase in market share. Honda has been seen, declining their market share on a year-on-year basis. So Hero as well as Honda both have lost market share. TVS Motors has more or less been able to defend its market share, and Bajaj Auto is a clear gainer as far as FY19 entire market share scenario is concerned. Let's specifically talk about the scooter segment where Bajaj is not present. What exactly happened there is something interesting. For the last 6 years or so, we have seen for the first time in FY19 the scooter sales on an absolute basis decline. Last year scooter sales were over 67 million. This time we have just been around 67 million. So if you look at the chart, the blue line, you can clearly see that how really the scooter sales have slightly come off. However, motorcycle as well as moped are seeing some bit of growth. So more or less we have seen the scooter segment slightly consolidate in FY19. Talking about the monthly sales growth figure and the exact thing that we were starting with, look at how really Bajaj Auto has seen the orange line wherein the growth rates have outperformed TVS Motors as well as Hero MotoCorp post-November. So post-November, if you look at Hero MotoCorp, there is a consistent fall in growth rates. In fact, the growth rates are started to decline. For TVS Motors, again, the trend has been flattish. And look at Bajaj Auto, they have maintained that 20-23% growth rate in the start of November, December. Of course, Feb was a dip month, but again, it bounced back to deliver a 20% growth rate in the month of March and on an overall basis. So clearly, post the November is where the inflection point really happened for Bajaj Auto. Till that time, everything was okay. The industry was doing well. But post the festive season, we have seen a crash sorts in terms of the growth rate of the entire industry.
Now, are there reasons attributable to this, Yatin? Whether it's financing, whether it's company-specific issues that are plaguing some of the companies, because what Bajaj is doing is not a factor of base alone. I mean, it's not coming from a minuscule base.
Yeah, so it's not a minuscule base. Of course, the base was low for Bajaj Auto because they were struggling last year to Hero MotoCorp. What they exactly try to do is that take away market share in the commuter segment, which is basically the 125cc kind of a motorcycle range, wherein there was a price war. The managements of both Hero MotoCorp and Bajaj attributed that there is some price war as far as the entire commuter segment is concerned. So from there they started getting volumes. So Bajaj picked up volumes there as well, and the new Pulsar has been doing really well for them. They have crossed over 1 lakh units in terms of sales for the last few months. So clearly Pulsar is also another factor because of which Bajaj Auto has been able to get a decent amount of market share. And on an overall basis, they have schemes like 555. They have been, dealers have been discounting certain models. Of course, Hero Moto also has a rural presence. A lot of economists and people who come to our channel talk about rural stress. Wedding season, slightly bleak. So by presence itself, Hero MotoCorp has not been able to get that number from the rural market, wherein Bajaj Auto has been able to monetize the urban markets as well as the new Pulsar as well as the new launches that they have done in the marketplace.
Okay, just one follow-up. The last quarter when the numbers came out for TVS Motors, I heard a lot of people who came on air and said that that quarter was a bit of a game changer for TVS. Now, when I look at the charts of the monthly sales numbers, as for Hero, so also for TVS, the last 4 months have been months of decline.
Months of decline, but Neeraj, the decline is not that sharp for TVS Motors.
Sure, on a relative basis.
Because what has happened is that Hero MotoCorp had significantly cut down production, significantly cut down on wholesales. So there is a double-digit, a 20% kind of a decline.
No, I'm not comparing it to Hero, but they've not had growth by any stretch of imagination.
So if you look at the last 3 or 4 months for TVS Motors, the growth is in the range of 1-2%, 3%, 4%. But they've not declined like Hero MotoCorp. And that is the reason why if you look at the market share data, TVS Motors has been able to hold on. And more importantly, also have presence in the scooter segment, which has probably helped them do better in the southern markets. Vis-a-vis Bajaj and Hero MotoCorp.
Okay, great. Yatin, thanks so much for putting this into perspective. That's a complete lowdown of what's happened to two-wheelers in the months gone by. Very interesting discussion. Last piece on First Word today. Railway component manufacturers are sitting on substantial input tax credit as they pay 18% on input, while the tax on the finished product is capped at 5%. This has led to these players demanding a refund, but the GST Council has another plan to help them narrow this gap. Nikunjori tells us what the plan is.
The government is considering to give relief to railway component manufacturers as the industry is facing issues in utilizing the credit of tax paid on its input. Since GST was implemented, the industry is facing an inverted duty structure issue, which means that the taxes on its inputs are higher than the tax on its output. This leads to accumulation of credit of the tax paid on its input and in turn becomes a cost for the industry or these companies. So now the government plans to either give refund of the credit that has been accumulated or increase the tax on its output like bogies or wagons to 12% from 5% currently. The issue was discussed in several meetings of the GST Council, and the government had decided, had earlier thought of increasing the GST rate on the output to 18% from 5%, but then there were concerns raised that since there has been a lot of credit that has been accumulated over a period of time, it would lead to revenue loss for the government, since most of these companies would utilize this credit to pay their output liability. So now the government plans to either refund the credit or increase tax on their outputs from 5% to 12%.
Well, that's all that we have on First Word today, but lots more lined up on Indian Open. We discuss what different sectors could do in the earnings season with Harendra Kumar of Elara Capital. He joins us at 9 a.m. Speak to Vinkesh Gulati of United Automobiles about the changing dynamics in the two-wheeler space. And as Infosys and TCS kickstart Nifty earnings today, we talk about what one could expect from the IT companies with Girish Pai of Nirmal Institutional Equities. But after this break, a full tilt towards the day's trade.
What is the meaning of this word suspense? Suspense is something very intangible. Say we show somebody getting killed. For me, I'm not interested in a whodunit. The moment the audience knows that this person has done it, and he has to ensure that he doesn't get caught, there is a certain tension in that. I try to give away as much as possible to the audience and still keep enough aces up your sleeve. I don't think any director will be able to say, okay, this is my style. I don't think I can define it.
Watch his exceptional story, Pursuits by Chadha, only on Bloomberg Quint.
Better? Same. Now? Abhi? I think so. Sometimes we can't see what's right in front of us. And when it's clear, then the big picture becomes fuzzy. Perfect. The right lens always is.
Welcome back. You're watching Indian Open right here on Bloomberg Quint Live. Good morning, Neeraj.
Good morning, Devina. Well, just like yesterday, flattish, lackluster start anticipated. Let's see volumes pick up. But I dare say more action in the markets or market-related action post-market hours today, with the IT majors coming out with numbers and CPI numbers coming out as well. In terms of news flow, might be a dull day today.
Yeah, so it's going to be more of what happens Monday morning when we come back in terms of market reactions. But yeah, you're right. A lot of news flow that comes out post-market hours today. We're also going to be keeping a close eye out on what happens with regards to the index itself. It seems to be a little bit fatigued right now over the last few days.
Maybe with reason, right? Now waiting for the earnings to come in. If indeed banks deliver and if IT doesn't disappoint, then 45% of the earnings taken care of.
Yeah.
Maybe that's what the market is waiting for. Otherwise, 18, 19 times, you would expect that everything needs to click for the markets to move up.
Pause a bit, take a little bit of a breather after this kind of move that you had. All right, let's take a look at the derivative space then. And Agam Vakil is standing by with the update on that. Agam, good morning.
Good morning, Devina. Well, as you mentioned, we are looking at a little bit of subdued undertones when it comes to the benchmark indices, which is why we saw the Nifty remain largely flattish at this point in time. We are looking at unwinding of open interest down by as much as 2.3%. As far as the Nifty banking futures go, again, marginal weakness coming through with significant unwinding of open interest by as much as 9%. The India Volatility Index has come off, but it's still above the mark of 20, and that will always remain as a problem. But moving on to your open interest change, we're seeing a little bit of writing around the 11,800 call. Keep an eye on that one. But when it comes to open interest distribution as a whole, here not much has changed as far as your range goes. It's between 11,500 and 12,000. The Nifty put call ratio did come off to around 1.24 against 1.3. And moving on to your factors, such as those in the F&O band, DLF, IDBI Bank and Jet Airways, along with PC Jeweler, Reliance Power and Wockhardt are in the F&O band. Diwan Housing Finance returns, moves back into the band. And we have Adani Power moving out of the F&O band, so we are watching out for these stocks. So Geon Financial continues to move from strength to strength. It's made another up move around 2.6% with another 11% added in open interest. So watch out for longs there. Of course, Diwan Housing Finance, as I was mentioning, because of the 10% increase in OI, we've seen that move into the F&O band. Moving on to your to PVR at lifetime highs, of course, a lot of longs building there. And finally, we also have something like a Tata Global Beverages, which is looking at a lot of longs coming through. So a lot of buying across a lot of these companies. We've continued to keep an eye on these. And of course, TCS and Infosys, those reactions will probably be post-market. That is on Monday.
Right, Agam. Thanks very much for that. And Diwan Housing Finance could anticipate a move in this stock on the back of that downgrade from Brickwork across its various instruments. The stock of the last 1 month, though, has seen a pickup. It's been up about 34%. Gurmeet Chadha, co-founder and CEO at Complete Circle Consultants, is joining us on the show this morning. Gurmeet, good morning to you. The two big names to watch out for. Obviously, you may not see a big reaction during market hours today because the results come at post-market hours. But what have you factored in for the likes of Infosys and TCS?
So Divya, looks to be, in our assessment, a steady quarter. I think taking, let's say, Infosys first, I think in constant currency terms, you could see a 2% plus kind of a growth. There will be a bit of a margin impact due to rupee appreciation of almost 1.5–2%. But I think that's likely to be offset by the deal win momentum. This quarter again, they could be close to $2 billion of deal. The digital deal size also has gone up, other than the number of wins they have had. So that's likely to be a bit of an offset. Only thing I would like to probably watch out for is the increase due to the talent crunch. So there's been increase in subcontracting. There has been visa rejections are at an all-time high. Infosys also has had some attrition. So there have been, I've been speaking to some colleagues of mine. There have been some out-of-turn promotions and other stuff to retain talent. So that would be interesting to watch out for. And they do give guidance. So if they can, up the guidance slightly bit, it could be a bit of a positive for the stock. Also, it has a bit of a premium, in terms of discount to TCS, about 18% on valuations. It's roughly about 18 times earnings. So amongst the two, maybe more positive on Infi, but looks to be a steady quarter to me.
Okay. So steady quarter, but as we said in our presentation or in the first word link as well, do watch out for the margin guidance from Infosys and the total deal value from TCS. Those would be important monitorables. Gurmeet, what remains in focus is Jet Airways, right? Now, international operations suspended. There are talks of Etihad having submitted a bid as well from other media that I'm picking up. So lots of news flow surrounding this. You do not know which side it will land up. But the question is, what does an equity investor do in such a scenario, especially the one who has the shares of Jet Airways?
So Neeraj, I would, any day exit Jet Airways at whatever price. You could possibly see some upside movement today. Probably use that, opportunity to exit. Go to a stronger player if you want to be in aviation. I would, although I'm not a great fan of aviation, maybe Indigo is a better bet. Maybe SpiceJet from a tactical point of view, since we're going to take some more planes of Jet on lease, could be a bit of a play. And we have discussed this. I think the better way to play is, get into Indian hotels, get into a VIP industries. That's a better way to play this surge in domestic traffic and increase air travel and more tourism. Indian hotels, if you see, we discussed this a couple of days back. They are likely to add. The current room size is about 17,500. They have given a guidance of 25,000 by 2022. They have abandoned the mono brand strategy. So, they have now launched a curated collection, which is in the name of Selections, which is basically maintaining the identity of the local chains, like a president in Mumbai or a ambassador in Delhi. They are also working on their restaurant and the F&B space quite aggressively. monetizing a lot of their assets. I was surprised to see they had about 131 apartments and quite a few land banks as well. So they're monetizing that to make the balance sheet look stronger. The ARR is up, the occupancy rates are up. Better strategy units at 150 rupees right now. You could possibly it could be a doubler in 2 years, 3 years. So better play that as a space than get into something where 80% of their cost is completely not in your control. Whether those are fuel prices, whether those are the lease agreements. Very difficult. So many. It's a sum of so many moving parts. It's very difficult to take a call on earnings in aviation.
Yeah, fair call. But just keep in mind though, today Indian Hotels is a stock in news. I think New Delhi Municipal Corporation of NDMC is going to get a higher rate for Taj Mansingh compared to what it used to get earlier. It's just one of the many properties that they have, but it's a marquee property. And I think that seemingly might have an impact. We'll of course talk about it in the huddle, I reckon, when we talk about the stocks in news. But do watch out for Indian Hotels as a stock. Gurmeet believes that the new management and maybe the hotel industry on a bit of a uptake might also work well. The other very interesting thing out here is that if you look at the last 2-3 years, Indian Hotels as a stock hasn't done anything. EIH has probably doubled or trebled from maybe 60 or 80 rupees. EIH has moved northwards of 200 if I'm not wrong, if my memory serves me right, 191. Yeah, so 3 years about 74%. So not double, but something like that. But Indian Hotels in 3 years hasn't done anything at all. So there's a bit of a dichotomy between the two of the largest listed names. Let's wait and watch.
But the new entrant in the fray, Chalet Hotels, that's the one that's...
Or Lemon Tree.
Yeah, they're breaking ground over the recent past.
Most definitely.
All of the players within this pocket. But we'll talk about all of this and more. But I also want to talk about Diwan Housing Finance with Gurmeet. But I'll leave it for now. We've got some stocks that we need to watch out for, which is some stocks in news. Agam is also going to join in to talk a little bit more about foods and ends, and we'll see how all of this plays out in trade today. Both Darshan and Agam are here with us to talk about all of these stocks. Darshan, let's start off with you first on some stocks and news.
Yeah, so Jet Airways continues to be in focus. What has happened is additional 10 planes have now been grounded because of a non-payment of dues to the lessors. The other news that have come out is that the long-haul flights, international flights from India have been suspended. Operations to east and northeast of India have been suspended. So trouble continues to grow for Jet Airways. Diwan Housing will be in focus. Remember, the count was in the F&O ban, but the news that has come out is that the Brickworks ratings downgrades the company across various instruments. They say that the main reason for the downgrade is limited progress in building up liquidity. Lumax Autotech is in focus. They have a joint venture agreement with a German company for manufacturing and sale of automotive components. Both entities will have a 50% stake in this joint venture. ICICI Prudential Life Insurance sells in almost 2% stake in Coromandel International. Prabhat Dairy completes the sale of its shareholding in Sunfresh Agro Industry, which is their wholly owned subsidiary to Tirumala Products. And AGC Networks, it's a smaller company. They have entered into an agreement to acquire 100% stake in COPC Holdings for $5.5 million.
Right, Darshan. Thanks very much for that. Agam, Foods and Inns, marquee name picking up stake here?
Yes, that is the highlight here. We have a marquee name. We have Radhakishan Damani's Derive Investment picking up 4.7% stake in the company. It's a relatively smaller investment, but what is actually important is that the marquee name is now attached to this particular company. So Foods and Inns is actually an exporter of processed tropical fruits, purees and vegetables. But according to its annual report of FY 18, it gets 100% of its turnovers from fruit pulp and concentrate, and this is to do with mangoes. The company has factories in Mumbai, Chittor, Valsad, Sinnar and Gonde, which is near Nashik. And of course, this particular stake is being valued at around 14.5 crores. The market capitalization of this particular company is a little over 300 crores, but it's listed only on the Bombay Stock Exchange. And as far as its revenues are concerned, it stands at around 344 crores in FY 18, and its operating margins currently are somewhere around 10%. Of course, with its net profits around 3.5 crores for the year gone by. But on the whole, we are talking about this company because of the fact that the name that's been attached. And we saw some strength yesterday. We're likely to see that follow through today as well.
All right, guys. Thanks a lot for that, Agam and Darshan there with some important stocks you need to watch out for as we step into trade this morning. Gurmeet, I want to talk to you about Diwan Housing Finance and now Brickwork downgrading various instruments, talking about them not being able to spruce up liquidity. What's the sense here? I mean, do you feel that the stock's done well, though, 33% in the last 1 month? Do you think that about caps it?
Looks like till the time the overhang, and I'm a great believer, till the time the trading of the paper starts, there's virtually no trading in DHFL for last 4 to 6 months. So all of them are off-market deals. Fund houses taking a bit of a markdown and settling. Although must say that the promoters have honored all the commitments so far. In some cases, they've done prepayments in a lot of NCDs which are due. So my sense is till the time the material decisive stake sale happens, a more credible partner comes in, I think the stock would be more like a trading opportunity. Housing finance in general, Devina will have a bit of a stress. I think if you see largely all names barring HDFC Limited, the mortgage book is about 60-65%. The other part, 1/3, is developer loans, which could see enhanced stress if not looked after right now. So I would in general avoid the HFC space. Look at more diversified names in the NBFC space. Look at, for example, a Chola, which is 70% into vehicle finance, and the balance is just home equity and other stuff. You could look at the Shriram Transport. There are talks of the merger with the Shriram Group. So there are better plays there. Obviously, Bajaj Finance and HDFC Limited being the top ones and slightly expensive ones. But the liability side of your balance sheet will determine your upside, not the asset side.
All right. And since we're talking about trading plays, it's time to bring in our technical experts, Rahul Randeria, an independent market expert who joins in on the show right now. Rahul, since we spoke about Diwan Housing Finance being a trading play right now, is that something that you go by too?
Yeah, definitely. Last couple of days we have seen some sort of volume activity with a positive bias in Diwan Housing Finance. But in the last couple of days we have seen that the stock has rallied nicely from the levels of 150, and currently it is just quoting around 170. So definitely maybe 177 on the upside could be seen, where some sort of profit booking could emerge at the higher levels. So at this point of time, those who have bought at the lower levels, one can try to book at 177, 178. But definitely slowly and gradually the momentum is picking up in the stock. But ideally to enter fresh in the stock, I would wait for some profit booking, and that would the levels I would be comfortable entering those into DHFL is around maybe 161, 162. But definitely at 177 we could see some sort of profit booking coming in the higher levels.
Gurmeet, can I try my luck with Foods and Inns? Have you ever looked at this company? It's a small stock, but a marquee name entering it.
Neeraj, not very extensively, but minutely, especially with a lot of news of Mr. Radhakrishnan Damani getting into it. I'm in general very positive on this space. I think there are very few listed plays, Neeraj. One of them, so a slightly unrelated one which we track is Avanti Feeds, which is shrimp processor into shrimp processing and exports. So I like this space. I think this is a multi-year growth opportunity. The market cap of the company you mentioned is just 300-350 crores. With a 3-4 crore kind of a PAT. I think this can go up 4-5x. So it could be a good 1.5-2 year play. And with the marquee names entering, the concern on promoter and corporate governance also, while it's not a guarantee, but it slightly to a certain extent gets addressed. With marquee names entering. So positive on this space, and it could be a good multi-bagger for, high-risk investors who want to take more exposure to small and mid-cap space, small and micro-cap space.
Okay, Gurmeet is talking about Foods and Inns as something that could be a multi-bagger, that could have a 4x to a 5x view, not Avanti Feeds, mind you. The thing about Avanti Feeds, so this stock, well, the last 3 months has done reasonably okay. The thing about Avanti Feeds, I just wanted to bring in a point out here, is also that if you just look at everybody talks about demand and how demand is, etc., so on and so forth. But the supply side is an important monitorable as well. And Avanti had a great run while there was no competition. Once Ecuador and some of the other countries started exporting shrimp and the feed products that Avanti Feeds or some of the others started were exporting to the US, I think then the businesses just come off, and which is why in the last 12 months, look at that performance of the company. You can argue that mid-cap stocks, all of them have come off, but a lot of good names have bounced back too. This is not a bad name. It's just that the business is going through a shift wherein internationally a lot of other countries are now coming in and giving in their supply, and that comes in as competition for Avanti Feeds. So that's something that you got to keep in mind as well. But Devina's right, it's 8:45, so let's bring in our technical experts on board and try and figure out what to do for trade this morning. Rahul is already with us. He spoke about DHFL. Rahul, just a quick thought on what would you do with the indices today? Would you trade the Nifty or the Nifty Bank today?
Yeah, I would trade. Rather, last 6 days, what we have seen, the stock, both the indices, we have seen selling pressure coming at the higher levels. But as well, on the lower side, we have seen support also. So strategy would be sell on rise and sell on resistance areas and buy on support areas. So definitely, for today's trade, I have a sell call in Nifty. One should go short in Nifty on rise to 11,641, which is the spot level. Downside target is 11,549. Stop loss would be 11,711. In Bank Nifty, again one can go short on rise to 29,920. My downside target is 29,597 with a stop loss of 30,079 on the upside.
Okay, so do watch out for these index strategies from Rahul Randeria. Rahul, what about specific stocks? What is it that you're recommending today?
Yeah, I do have 2 sell calls in on stock specific trade also. Sell on rise in sale around 57.50. A downside positional target is 50 with a stop loss of 61. A second sell call is in Jubilant Foods. One can sell on rallies to 1398 with a target of 1314 with a stop loss of 1432 on the upside.
This is interesting. Yesterday we were talking about Jubilant Foodworks because the stock had corrected 2.5% and ended at the lowest point of the day. Even in yesterday's session, the experts who were there with us mentioned that this is a stock that was looking like a sell call based on near-term trends. Rahul Randeria this morning comfortable going short on Jubilant Foodworks as well. Let's wait and watch what happens here. 1375, down about 2.5%. A good run in the last 1 month largely, but off late has come off. So in the first 15 days it did very well. The last 15 days it hasn't quite managed to do well and has given up almost all of the gains. So do watch out for Jubilant Foodworks. Interestingly, while Jubilant Foodworks, and you can argue, Devina, that the same-store sales growths have largely done well, its peer, Westlife, has been on a roll when it comes to the same-store sales growth. The delivery, the cost control, everything has been picture perfect, near picture perfect for Westlife Development.
It's interesting to see what kind of numbers they post in Q3 and whether or not the growth matches up to the excitement on the stock or not.
Yeah.
The other stocks actually that were active in yesterday's session, one being SL Propack. The stock moved up about 5% in the session yesterday. 122 volumes were decent. It wasn't on the back of very heavy volumes, but nonetheless the stock had been beaten down recently, and you're seeing a shift of that happening now, a pickup from the lows. The last 1 month the stock's picked up about 10% odd. Rahul, SL Propack at 122?
Yeah, Devina. Since June 2018, the stock has failed to cross 126 with multiple attempts, and again this is the 4th to 5th time it is again nearing to those levels. As you mentioned, that volumes are picking up slowly and gradually. Yesterday was an engulfing bullish pattern. It is a slow moving stock, so definitely not a high risk traders I would recommend. It is a trade for the patient trader, those who wants to trade for maybe 1 or 2 months. Definitely from current levels, the stock has potential to test the levels of 145 on the upside. So one can accumulate in the current range, and one should place a stop loss just below 110 for the target of 145.
Okay. Shrikant Chouhan with us as well. Shrikant, good morning. What's the strategy on the indices today? Do you reckon that there is a trade possible?
Good morning, everybody. See, the Nifty is very clearly in a range. It is not going anywhere since last almost 8-9 days. And like yesterday, the market was very close to its important support area of 11,550. Today, in case if we see the market is breaking these levels, certainly like one can go short in the market. But the problem is that today, Infosys and TCS, index giants, they are going to announce their numbers. So towards then again, we are expecting market to recover back. So I think there should not be any like a specific way to like trade in this market, at least in today's date. So my view is that the market is going to remain in a range for the day. Yes, maximum on the downside we can expect 11,500. But from there again we are expecting rebound because the option data is clearly suggesting that at 11,500 there is huge amount of position is lying. On the higher side 11,650, 670 would be hurdles. So strategy should be to look for adding long position if there is any deep sell-off in the first half close to 11,500 because again we can expect some recovery during the day. For the Bank Nifty also the strategy is similar. There also we saw good amount of buying attraction close to 29,600 and since last 3 days Bank Nifty is trying to fall below this level but it is recovering back. So there also strategy should be to look for adding long position if we see Bank Nifty is falling to 29,500 levels.
All right. So consensus view there that take it easy on the index. Probably play the market through individual stocks, and we'll come back to Shrikant's stocks in just a few moments. He's got quite a few of them, so we'll talk about all of those. But onto a special segment, Bloomberg Edge by Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock today?
Morning, Devina. So we are looking at Edelweiss on the charts and a sell signal coming in yet again on the counter. We had seen a sell signal come up a couple of weeks back. In fact, when it was trading at the mark of 200, but today again there are more indicators saying that there could be further weakness. And this time around, we're looking at the formation of a bearish engulfing pattern on the charts. What I mean by the bearish engulfing pattern is the formation of a large red candle right after a green candle, wherein the body of the second candle completely engulfs the one ahead of it. The larger is the size of the second candle, the higher are the odds of the stock weakening from these levels, and no further confirmation needed there. Edelweiss, as I mentioned earlier too, had popped up on our radar when it was at the mark of 200. We saw significant amount of weakness there. It managed to give a bounce, and again it is trading very close to the mark of about 180. Yesterday too, it closed very close to its day's low. And on the back of that, we are seeing some weakness. The Trender 2, which is another proprietary Bloomberg indicator, is very close to the counter's current stock price. Should it weaken from the current levels and manage to close below that, we could see some more amount of weakness following in. But as of now, the bearish engulfing pattern on the charts suggests that from these levels, we could see the stock fall further.
All right, Yash, how well has this worked in the past?
So, Devina, 3 out of the last 6 times that this has occurred on the charts in the last 1 year at least, the stock has managed to fall as much as 5% over the next 1 month.
All right, Yash, thanks so very much for that. That's BQ Edge for you. And today we were talking about Edelweiss and the sell signal that came about there. Let's talk about Shrikant's stock ideas as well. He's got 3 of them. One, a buy call. Actually, he's got 4 of them. He's got Ultratech Cement, he's got SBI, United Spirits, and NCC. All of them buy calls.
Yeah, they will. See, like the way the market is in a range and the broader market is like really strong. A number of stocks are doing well on day-to-day basis, and there is sector-specific rotation which is happening on a weekly basis. Yesterday, when there was a closing of the market, we saw a good amount of activity in almost all cement companies, and in that, Ultratech Cement looks good. India Cement is also like showing a lot of strength on daily charts, but it was very close to its important resistance area. For Ultratech, we feel that it is heading for the levels of at least 4270, 4300 on the high side. So here we should look for adding some long positions with a final stop loss below 4050. Currently it is around 4150 levels. The other stock which we like is from the PSU bank space. State Bank, which was around 335, 337 levels. From there all the way we saw correction in last 4 or 5 days, and it was around like 309, 307 levels since last 2-3 days. So it is stabilizing around those levels, and again we are expecting stock to rebound to the next levels of close to 330. So there also we have a bullish view with a final stop loss below 306, and we cannot forget that the stock has given long-term breakout on quarterly charts. So it's a classic buy at current levels, more on dips. The other stock which we like is United Spirits, where also the formation is of bullish reversal on daily basis, and there we are expecting stock to move towards 575. It's a high beta stock, and we can expect some momentum in this market if there is a range bound activity. Other stock, and the last one is NCC, which is around 105, 104 levels, and here also the stock has completed its correction, and in last 3 days we saw some buying attraction, some good delivery based volume close to this 105, 104 levels. So it's a buy at this price with a stop loss at 102.55, and on the high side we can expect 111, 112.
All right, so all of the stocks need to be watched out for. Gurmeet, comment on the two-wheeler space in particular. You know, we spoke about them in the morning session with regards to what's happening to a Hero MotoCorp, a Royal Enfield, and how their sales seem to be wavering a bit. You know, is there a change of drift here?
My sense is that the coming couple of months would be good for two-wheelers, and especially for Bajaj Auto. If you see, they started the year with sub 15% market share. They probably will close at about 22-23%, which is a 7-8% kind of a gain. Their models across the platforms are doing well, barring the CT100. Which hasn't done too well. So new product launches, three-wheeler sales have been very, very positive. I think the work they have done on the exports, probably the others will probably take another 2-3 years only to catch up. In fact, I was hearing the Bajaj team commentary a couple of days back, and they said that even if domestic sales were to become zero, the company would still be 50% of what it is. They have good cash in the balance sheet, almost 15,000-16,000 crores, of which I think 7,000-8,000 crores technically can be given back as dividend in case they decide to or use buyback. So looks good to me, and also a lot of these tight credit conditions, high raw material cost, some of the insurance cost pressures because of which the price went up had a bit of an impact. There could be some impact with prices further picking up due to the safety and the emission standards. The sense we are getting in terms of speaking to a lot of auto dealers is that there is also a lot of push on GST cut for two-wheelers, with industry leaders, calling it as a common man tool, especially, the Munjals. So there could be some play there as well. So I would be positive on them. I would use the, dips to buy, but the preference would be Bajaj Auto in the two-wheeler space.
The views within the auto pack, Neeraj, some holding a very strong view that this should be an opportunity to enter. Rhythm Desai, we spoke to him and he said he's loading up on everything that's auto. And then other views saying that probably these are just trading opportunities, and you will, for an investment point of view, this is probably not a good entry point, particularly for the likes of Maruti, which has actually come off the lows now at about 71,000-72,000.
It's debatable. We haven't really seen a meaningful auto slowdown in the last few years, so don't know that if we are in the midst of one, how long would it last? So that's the first key point. But by and large, if you just look at the conversations that happened the whole of last year, wherein we talk about the demand versus supply dynamics, it wouldn't surprise anybody if this pack came back to, but just that it's just so difficult to say when everybody's talking about a growth slowdown across the world, and there are some financing issues for a lot of companies as well.
It'll be interesting to get in a dealer, perspective or a dealer check right now.
Today.
Yeah, whether or not things have improved on the ground in any material fashion.
Okay.
But aside from what's happening in the markets too, there are two macroeconomic data points coming out today evening. The retail inflation numbers for the month of March and the factory output numbers for the month of February. Shefali Malik is here to tell us what's in store. Shefali, month of Jan, IIP was I think about 1.7. What is the expectation this time around for Feb?
Well, for the month of February, IIP is expected to inch up slightly to about 2% versus about 1.7% on a month-on-month basis. And 8 core industries output, that likely moved up to about 2.1% versus about 1.5%. And the growth in the non-core sector production, that eased slightly to about 1.7% versus about 1.8% on a month-on-month basis. So that's the expectation that we have with regards to the IIP this time around. And probably all these measures that we've been seeing in last couple of months, with RBI cutting down rates and also infusing liquidity continuously, so all that probably is going to reflect in the increased or the pickup in the IIP numbers this time around. As far as CPI data is concerned, we're expecting that to come in at about 2.8% for the month of March 2018 versus about 2.57% on a month-on-month basis. And food prices are likely to inch up slightly this time around, likely to come out of deflation that we've been seeing in the food prices. And important to note that CPI will continue to remain below the MPC's, that is Monetary Policy Committee's target inflation for 8 straight a month. And core inflation, that is likely to come down slightly to about 5% versus about 5.2% on a month-on-month basis. So that's what broadly we look forward to from these two macro data points when they're released in the evening today.
All right, Shefali, thanks very much for that. So, two macroeconomic data points to keep an eye out on. Back to the markets then, and Rahul, over the last few sessions, we've seen some interest that's come back into a stock like Shankara Building Products. Quickly, 30-second answer if you do have one call on Shankara Building.
Yeah, definitely. The chart seems to be looking positive, and yesterday's chart has indicated a very strong bullish pattern supported with strong volumes. Slowly and gradually, the stock has been picking up momentum, and it has seen a flag pattern breakout of last maybe 15-20 days of consolidation. So definitely on the upside today, we could see the levels of maybe 550 to 560. But for today, one has to wait for some cool off. Maybe one can buy in the range of 518 with a stop loss below 500 for a target of 550 to 560 on short to medium term.
Okay, got that. Yesterday, though, the stock was up about 9%. 20 seconds left to go for market pre-open. Indications suggest that we could have a softer start. SGX Nifty is down 1/3%. The rest of Asia, no mixed bag. Nikkei 225 is up in the green, while the other two markets, as China and Hong Kong, are trading flat to negative in the early morning session. Should be getting those ticks on your screen. And watch out for the currency too. Yesterday's session was good. We saw some strength building up back under 69 for the rupee. That's about 68.9 orders where it's shut shop. Nifty 50 flat open, and so is it for the Sensex with a marginal uptick of about 0.5%. Stocks to watch for. We don't take a look at what's been happening on the index movers. GAIL is up 1%. BPCL is up 1%. Wipro moves up 1% on the counter. Watch out for Wipro on April 16th. The management is likely to announce a buyback. Tata Steel, that's up about 0.5%. Power Grid, Bajaj Finance, Bajaj Finserv. Titan moves up about 0.5%. You got the likes of Cipla, that's up 1/3%. And the overall breadth is positive, but in terms of the quantum of gains, not all that much. TCS has opened absolutely flat, and so is the case with Infosys. No major moves here. HCL Tech, however, is seeing some downside in today's pre-open. That's down 1.2%. Infy is also in the red right now. Kotak Mahindra Bank flat. For the currency, we're at 69.03, so some amount of weakness is coming this morning.
2 or 3 stocks in focus just very quickly. Jet Airways and international operations suspended. Let's see if that is having an impact on the stock or no. Well, initial impact, I doubt it will be a 10% downtick, though it could well happen. Let me not try and preempt, but a 10% downtick seems very severe. Let's wait and watch. The other one is Foods and Inns, small stock, but big name in that. Did have investments and a big move, and this you wouldn't be surprised if indeed the extent of the move is this much, but again, let's wait and watch what happens here. And then of course we'll watch out for companies like SL Propack and a few others which have had a good session in trade yesterday, or a Jubilant Foodworks which had a bad session in trade yesterday. Let's see what happens there, but we'll get to them in a bit. Let the pre-open rate settle down a bit. Let's first get in Somit Sarkar, who joins in with the top brokerage calls for the morning. Morning, Somit.
Good morning, Neeraj. On the big brokerage calls for the day, first we have a Credit Suisse on Havells India. Now the brokerage has downgraded its rating on the stock to neutral from an outperform and has marginally cut down the target price to 780 from 800. Now according to the brokerage, so far the strong growth in Havells was supported by the cables and the consumer durable segment. But now going forward, the cable segment, it is expecting a slowdown in growth post the election period. Along with this, it also says that the consumer durable segment, it is expecting Lloyd segment to face margins and growth pressures in the summer season, as the company is largely dependent on imports, which will get impacted by the 20% import duty. Lastly, it says that the stretched valuations of the company and the earnings estimate leave a very little room for further upside when it comes to Havells India. But the second stock we have is a Motherson Sumi, where HSBC has maintained its buy rating on the stock but has cut down the target price to 170 from 233. Now the brokerage has cut its earnings estimate by nearly 15 to 30% for Motherson Sumi due to factors like slowing car market, currency headwinds, and the slower ramp up of its new plans. However, despite this, the brokerage has maintained its buy rating as it keeps faith on the content growth story for Motherson Sumi. Along with that, strong margins for the SMP division, integration benefits, and potential for attractive acquisitions are the reasons why the brokerage has still a buy rating on the stock. Lastly, it says that the fourth quarter earnings would be another slow quarter for Motherson Sumi, but for the financial year 2020 and for financial year 2021, it is expecting a strong earnings growth from the company and free cash flows that the company is expected to deliver in the next 2 financial years.
Thanks a lot for that, Somit. Gurmeet, Chadha, before we thank you, let me ask you about Motherson Sumi. It's a company which is in, well, some bit of stress in the last few quarters. Is it temporary? Is it turning around? Would you invest in it?
So Neeraj, I would at these price levels looks attractive to me. If you see, it's the largest wiring harness player. Started off as a supplier to Maruti in '86, and the way it has come off. I think there were some concerns on the 18 billion guidance they gave, because out of which 6 was through inorganic route. So I have a feeling that the auto component makers and some of the others will have a slightly better numbers than the regular auto guys, because there is also a strong and profitable aftermarket number which they have. Also, as I said, there is a demand for rising content per vehicle. They are also the second largest in the rear view mirrors. So my view is that at this price it looks good. It might just consolidate for some level, some time before there is a material upside in some of these auto component makers. But use the dips to add some of these names, because as I said, they will probably have a better optical number than the automakers, which we'll see even in Q4.
All right, we'll leave it at that, Gurmeet. Thanks so very much for joining us this morning. Harendra Kumar, Managing Director for Institutional Equities at Elara Capital. He's joining us on the show right now. Harendra, thanks very much for taking out the time. What is the call at Elara now in terms of the overall market direction?
I think the Indian market is a very, very critical juncture. It's positioned ripe for a breakout. I think there are two macro variable triggers at the moment. One is, of course, over the next 3 to 4 years, the earnings CAGR is extremely strong at 20-23%. Number one. Number two is obviously once we cross over the hump of the elections in May, the possible risk that's priced into the market gives way, and there could be a re-rating. I think the conjunction of these two events could lift the market above into an all-time high. And I think from there, in terms of sectoral preferences and your stock picking changes. So I think the next 2 months are decisive, but broadly we are quite comfortable that the market is breaking out into a new zone.
Your note, Harendra, good morning, Neeraj here. Your team's note on Q4 is pretty interesting too. A bottom line boost, but a muted top line. Is that the kind of quarter that you would settle with when you're looking at predicting that the index would have a breakout time?
Yeah, Neeraj, actually if you look at it, but the banking sector is actually showing quite robust growth. And that's very qualitatively, it's quite a healthy sign, be it Axis Bank, ICICI Bank. These are large cap index heavyweights. So I think that is the outlier event here. And second, of course, the liquidity crunch that had hit the market is also easing up. If you also see the credit growth for the year for the banking system is quite decent in the mid-teens, and I think it is looking to go up from here on. So valuations which are the comfortable zone, credit growth uptake, and easing of liquidity mean the banking and the financial space, which is a large composition of the index, could lift the markets higher.
That's where exactly, Harendra, are you seeing leadership migrating now? Is it going to stay with the banks, like we've seen in the last few months, where the lead has been taken by banks? You think they're going to hold that position, or you've seen leadership migrating somewhere else?
No, I think banks will maintain the leadership out there, but I think the shift out there is that last year and the year before, the NBFCs were the outliers. I think they had a phenomenal run out there, but their market share has been taken over by some of the aggressive private banks such as ICICI and Axis. And secondly, I think you're in a very, very interesting zone for the PSU banks, because they're beaten down, they're trading at sub-book. There is a commitment from the government in terms of recapitalizing them. I think once the clarity on the RBI reserves and how they want to recapitalize PSU banks comes through, the PSU banking space is also looking to contribute or add on to the space. So I would say that within the banking space, there's some rejigging and reallocation happening. So you need to realign to that.
A stock check, Shrikant, on ICICI Bank and Yes Bank?
Devinasi, like for ICICI Bank, view is very clear that it is into strong hands. The stock is managing to form higher highs whenever there is any specific rally in the market. This time also, after hitting the levels of 405, 410, now it is again correcting back to its important support area. But I think the way there is like buying attraction at 380-85 levels, we are of the view that we should look for adding long position if there is any correction during the day close to 380-85 levels. But we like IndianOpen Bank, which is like trading around 1740 levels, and the way the stock recovered from its lows of 1450, 1500 to almost 1850, we are of the view that the stock is ready to cross its previous high of 2000, which is decent upside from current levels. So there are like number of picks which are like there to buy for, but IndianOpen Bank looks really good where the risk reward ratio is great.
Harendra, do you still see aftershocks of the crisis within the NBFCs playing out in Q4 for individual sectors?
Yeah, so there is some element of easing that's happening on the NBFC space, but I think some of the brokerage stocks such as IIFL, Edelweiss and Motilal, which have a mixed play of the market recovery as well as the NBFC angle, are better placed because you have triple tailwinds out there. And if you're expecting market volumes to go up and the fee income from investment banking deals in the pipeline to play back, these stocks which had been beaten down could see a trading bounce, even for that matter, even ICICI Securities. So I think there's a capital market / NBFC play which is there to be taken, and some of these names could give you better returns, in relative terms.
Okay, minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. Infosys and TCS will kickstart the nifty earnings season today. Steady deal wins expected for both tech giants, but margin pressures would remain.
Jet Airways suspends international operations after lessors ground another 10 planes over non-payment of dues.
Dewan Housing Finance sees another downgrade. Brickworks downgrades ratings on various instruments due to limited progress in easing liquidity concerns. The stock likely to start off 3% lower.
Radhakishan Damani's Derive Investments picks up 4.7% stake in the BSE-listed Foods and Inns for 14.5 crores. Foods and Inns is a fruit pulp and concentrate exporter.
Watch out for Coromandel International in trade today. ICICI Prudential has cut its stake in the company by 3%.
Lastly, Lumax Auto joins hands with Germany's Job Holding in a 50-50 joint venture.
Well, that's gotten that stock excited too, 3.5% higher in trade. So some stocks in news, which are reacting. So Lumax is one, Foods and Inns is one. Jet Airways isn't quite reacting, but it's a stock that certainly remains in focus today. Harendra, what's the house view on aviation currently? Jet Airways is in a state of flux. In all probability will bounce back, but near-term gains for the others. Is it all in the price? How do you play this space?
No, it's not in the price. Actually, it's one of the most interesting trades over the short term, especially for, Indigo Spice. The reallocation of market share of Jet, I think that's the critical factor to look at it. It's already showing up in some of the numbers of Spice and Indigo in terms of the market share gains. Plus, you have tailwinds for the crude for the last quarter, which plays into the cost dynamic. So if, one of the incumbent players is successful in actually leasing out, jets, planes and the crew, that will be a massive trigger for the stock. So here the prime beneficiary could be SpiceJet. I think market is looking at consolidation industry and who's the potential beneficiary. If strategically they're able to realign some of the moves which are favorable for the company's fundamentals, the stock should see a significant re-rating from there on.
Reckon that this would be a tactical trade stroke investment as opposed to a slightly longer term one for either SpiceJet or Interglobe Aviation?
See, tactical it is, number one, because it's news-based and there are certain tailwinds of the crude and these market share gains over the last quarter which are playing up. It becomes structural if one of the players actually moves off from the industry, which is very unfortunate, but but it leads to the industry consolidation, what we've seen in telecom. So you would have a two-player market, one with 40% market share and one with 20%, and the rest which are weaker. That brings some stability to the industry and market. That players are then happy to take long-term positions. So I think that call, whether it becomes structural, could be taken after the Jet event is over and we've seen the final outcome of that. But at the moment, it's a very strong tactical trade.
Okay. Interglobe, Rahul, would you trade it?
Yeah, as we see, the aviation stock has been under limelight for the last couple of days, except Jet Airways. But looking at both of the stocks, I'm liking as they I just would say that SpiceJet is looking good. Currently, it is just opening around maybe 2% up. So on the upside, I feel that we could see a target of 110 on the upside for intraday basis. So, Indigo, I will be waiting for some time to wait for some dips, maybe around 1390 would be the area where one can accumulate the stock. But as of now, the momentum is in SpiceJet, so we could see an intraday spike in the stock for today.
All right, well, Interglobe has not been doing all that badly either for itself. Rahul believes this is a bigger trading opportunity in a SpiceJet versus an Interglobe Aviation. We're just under a minute left to go for market opening. So let's get in those top technical trading ideas from both our technical experts. Shrikant, why don't we start off with you?
See, I would like to go with Nagarjuna Construction, NCC, which is around 105 levels. Stock is corrected to its important support area, and I think the way there is a formation, we can expect at least 111, 112 on the higher side. So NCC looks a strong bet to buy at the opening with a final stop loss at 102.
Rahul?
I have two positional call. First is a buy in Gujarat Consumer Products. Current level is one can buy at 664. Stop loss should be placed below 645. Upside positional target is 700. And second buy call is in Finolex Cable. This is also a positional call. One can accumulate on dips to 470 with a stop loss below 450. Upside potential target is 530.
Okay, stay on, Jama. We'll just take in opening thoughts from you. But here's how the markets are starting off this Friday morning. Flattish, but maybe a bit more active than yesterday. Actually, no, I changed my words. It's almost akin to what happened in trade yesterday. Very, very flat for all the three benchmark indices. The Bank Nifty marginally in the red, the Nifty and the Sensex marginally in the green. The mid caps and small caps, and let's see if there's anything different happening there. No, not quite. The Nifty mid cap index about 34 odd points, but that's just about 0.2%. The small cap space very, very flat, about 0.1%. So hardly any big moves that we're seeing on the benchmark indices today. What about specific stocks? Let's get the heat map up on the screen. No big movers. Infosys TCS ahead of the numbers, marginally in the green. Reliance marginally in the green. So that's the heavyweight pack, which is trading slightly higher in trade and giving that bit of support. Don't quite see the HDFC twins in the top 10 gainers list at least. Actually, so they must be, they're kind of losing out a little bit. HDFC Bank certainly marginally flat, but no big losers either. HDFC is the top loser, down about 0.5%. Bajaj Auto marginally off, Tata Motors marginally off, but it's all over the place. HCL Tech is in the red, TCS and Infosys in the green. There is Tata Motors and Bajaj Auto, which are trading in the red. Some other rate sensitives, Bajaj Finance and some Eicher Motors, for example, is trading in the green as well. So it's mixed bag, even Stevens for the gainers and the losers. No big moves, essentially, the order of the day. Very quickly, since nothing much happening on the Nifty, maybe look at the broader end of the spectrum just before I hand it over to Devina for figuring out what's happening across the spectrum. Couple of stocks in focus. I thought more groundings and discontinuation of international operations for Jet Airways, not bringing about too much of a reaction, just a minor 1% downtick. What about stocks which have actually done well over the last 7 days, not just today? Let's bring those up. First source, big mover of the last 7 days, starting off flattish. India Bulls Real Estate has actually had great gains in the last few days, but in today's session starts off 3% lower. Similarly for Rain Industries, big mover of the last 5 or 6 sessions, and in today's session too, starts off about 1% higher. What are you spotting, Devina?
So I'll talk about the losers over the last few days, and they've had a decent bounce in the session. So in HT Media is up about 2% right now. You've got the likes of a Sterlite Tech, which has moved up too. Lakshmi Vilas Bank, that's up 1.5%, though this stock is done okay for itself. Last 7 days has been up about 9%. Hathway Cables 1.5% higher. Then you've got a Dredging Corp up 1.5% higher. A Parag Milk Foods 2% on this one. We've got the likes of you already spoke about Dredging Corp, but Future Consumer up 1%. GVK Power and Infra yesterday saw a big move in the last 20 minutes of trade. So GVK Power and Infra carries forward that move from yesterday. Delta Corp, Den Networks is up 1%. Fortis Healthcare. We spoke about SL Propack, that too carries on gains today. And a PFC is up closer to 1% right now. Amongst the losers, you've got Reliance Communication, no points for guessing. DB Realty along with India Bulls Real Estate loses out a bit. Diwan Housing Finance looks weak. That's down about 2% on the ratings downgrade from Brickworks. You've got PNB Housing Finance. This has been under pressure over the last few days, and so has Avenue Supermart. And both these stocks continue to lose steam.
I'm sure you mark foods and ins, but I just want to revisit that just once more for that big move. Just don't know the volumes as of now, but again, the volumes too would be thin, I guess. But the price action certainly very, very admirable. 223 and counting, starting off okay. Now, before we continue our discussion with Harendra Kumar, and we want to talk to him about the banking piece that he spoke about, just let's get in opening thoughts and final comments from both our technical experts. Shrikant, I'll come to you first. Based on open, anything that stands out for you?
Neeraj, see, like very clearly, cement stocks are doing well. Though Ultratech is like completely flat and unchanged, but India Cement, ACC, they are showing a good amount of strength. India Cement, which is around 109, 110 levels, there we are expecting stock to move towards 115, 116. So it's a buy at this price. Along with this, I think few other high beta companies like McDowell's, United Breweries, as well as United Spirits. All these three stocks are showing a lot of strength. And I think today we have to focus on those companies which are not part of index and having very high beta. So there we can expect further more activity.
Okay. Rahul, if I can come to you on a specific stock before we thank both of you, and that is Adani Power or some of the power names. They were very active in trade yesterday in the last half an hour. Adani Power has started off another 2.5% higher today as well. How do the charts look here?
Yeah, as you said, yesterday the stock has formed an engulfing bullish pattern. Today we have seen the follow-up buying supported with strong volumes. So definitely the momentum is picking up in the stock. Stock is forming a flag pattern formation. So in the coming days we could see a breakout. Definitely swing traders can buy at current levels, which is 51.90. Upside potential target, positional target would be maybe around 57, and one can place a stop loss below 48. So definitely with 52 and 50, that is the area where one can buy. And we could see a target of 57, 58 in the short to medium term.
Okay. Chairman, both of you, thank you so much for taking the time out and being with us today. Really appreciate it.
Yeah, thank you.
All right. Those are our two technical experts for the day, and a lot of stocks and a lot of ideas shared by both our experts, so do watch out for those. Harendra, I want to talk to you in a bit more detail about rate sensitives. I know you spoke about banks, and I'll come to that in a bit, but I just want to get your views on autos and the divergence that we're seeing in the last few days, wherein the auto index is not doing well. Largely two-wheelers, passenger vehicles, etc. are not doing well. The CV space seems to have come back a bit. If I leave out Eicher Motors because that's not pure play CV, Ashok Leyland, a big rise in the last few days. Tata Motors has actually come back from the brink of sorts, right? Yes, it's bounced from 150, but in the last few days, it's had a meaningful move upwards. CLS analysts talking about how the charts indicate that there are some significant upsides to this one. Is there something happening in the CV space, or are these idiosyncratic moves for both of these?
These are typical, bounce trades that are currently happening. Like you clearly mentioned, the two-wheeler and the four-wheeler are in a cyclical downturn that will take probably 2 quarters to resolve itself, if not longer. Specifically for Tata Motors is obviously, the market is repricing some positive developments or changes on the GLR front. There are no triggers locally as of now. So there's the repricing that's underway, and I think it will settle potentially some point closer to 250 to 60 before the market starts to reassess its growth trajectory or earnings. So I think it's more of a trading and technical bounce at the moment. There are no fundamental factors as of now driving even the stock level moves within the space.
Yeah. Harendra, the next piece is again just wanting your view because you haven't seen so many such cycles. The larger expectation is that the corporate facing banks will see PLL gains and credit costs could start off with the current quarter itself. In the anticipation of that, there has been some price movement already. Let's work with an assumption that those numbers do come out and the stocks react a bit as well. Would you believe that the play is slightly longer and therefore an ICICI, an Axis, maybe a Yes, I do not know about that one, but those 3 or 4 banks which are largely corporate facing banks, would there be merit in trying to invest in them if they show those numbers and the stocks react a bit positively already? Would there be merit in looking at them even after that?
Absolutely. I think at the beginning of a cycle, like we spoke early in the the day. So I think the valuations both for Axis and ISIS also very cheap. Except the subsidiaries, I think they've also gone out and indicated their ROE targets. So there's earnings plus the multiplier of the ROE that will work on the stock prices. So if you're looking for steady compounders, so I think both the stocks could give you a significant returns from you.
Just since we're on the topic of earnings, want your view, Harendra, on what exactly is it that's going to weigh down on earnings in which pockets? I mean, we already know that, so far the auto sales numbers have not been picking up. So autos firstly will have a weaker quarter. Agri stocks, NBFCs, stress in housing finance companies, telecom operators, are these the regular pockets where the pain will continue?
So telecoms recovering from the consolidation. So I think to that extent the pain is over for telecom. In fact, from here to the next 3 years, the earnings could look slightly better with improvement in ARPUs. But specifically in terms of earnings, so though it's tepid earnings, there are no major negatives. I think that will be taken positive by the markets because the market are poised for revival. So they're actually waiting to see where the revival actually takes off. Apart from autos actually doesn't have very significant weight in the index. So it will not weigh on the index so much as it plays up on individual stocks. So that's already priced in. So the market will look for revival, like Nirmal said, in terms of financials and possibly some of the other names. I think very interesting number could be Reliance Industries that one should track. I think over the next 3 quarters, that could be a stock which could actually lift the index higher apart from banks.
And what drives that optimism? Is it largely the non-oil and gas business starting to contribute in a meaningful way, or would it, on the bottom line, at least for the near term, remain an oil and gas driven earnings scenario?
It does. Actually, if you see the valuation in the market for Reliance is currently only the oil and gas space. The capex undergone over the last so many years actually has been given only part valuation by the market. I think it tends to get repriced as market gains more confidence on the new initiatives and potentially see some synergies playing up from the internet plus retail, etc. So I think retail clearly the market is watching and trying to analyze. So if there are any positive steps or outcomes, the market would tend to reprice it. And I think the company also gone out and articulated its outlook in terms of trying to deleverage on the telecom side by hiving off some assets. I think market is slightly concerned on the build-up of debt for a company like Reliance and the risk that it is piling up in its new initiatives. So if there are moves to actually reduce that, it will be seen as favorably for the market. So the valuation at which the telecom assets are divested also will be keenly watched. So there are earnings as well as some other triggers that will play up on the stock. Given that after 10 years of capex, market is looking for some kind of valuation catch up for Reliance Industries.
What about the much wanted consumption engine, which seems to be sputtering off late? Do you see things pick up here in terms of an overall volume growth compared to the previous quarter?
Sorry, for which sector?
Consumption.
Yeah. So like consumption, if you see there's been a small cyclical slowdown, but they remain structural buys. They continue to invest, and I think the volume growth numbers are quite robust. So if you ask us whether you need to be buying consumption, I think yes. So the down trading or the cyclical dip could be bought into, because structurally India remains the largest market in terms of consumption, and it will pick up after the sentiment improves post-elections.
Do you see any impact of elections on the oil marketing companies, particularly, the fact that obviously we've seen crude oil prices move the way they have, the currency come down below 69. Also, the fact that in the election period they're not really allowed to take any kind of fuel price changes. Does that impact meaningfully, or you don't think that'll bother?
I think what got the market disappointed was the abandoning of the free market mechanism when crude went up. Actually, that led to a strategic realignment of the positioning of a lot of investors in the OMC space. and it's not recovered after that. So I think the new government has to come out and make its policy clear in terms of petroleum prices, which the market had taken for granted. So I think till such time there's going to be no fresh investments. It could be only tactical buys. But as of now, we don't see any triggers specifically for OMC stocks in the short term either.
Harendra, a couple of smaller questions before at least I wrap up my questions. If I look at your report again, which has come in on Q4, and you guys seem to be very upbeat about the kind of numbers that the real estate stocks will deliver and contribute to the mid-cap earnings universe. There is a bit of an up move that has happened into these companies already, so they're not as well valued as they were 6 months ago. Do you think the earnings delivery can spark off a PE re-rating cycle of sorts, or whichever multiple that you use for them, the re-rating of sorts for them?
Yeah, Neeraj, I think the one trigger point is that the commercial market is actually beginning to look up. So that is one which is a very positive news for the sector. That means the underlying economics of the companies such as the internet companies who are buying out large spaces to run their operation, which is playing up in nice yields. Second is, of course, the companies that have hotel assets such as Brigade will continue to clock good numbers because the asset pipeline is good. And the third trigger, of course, was that the pre-sales for some of the company names like Shobha are clocking good numbers. So it's not as bad as potentially what people see. So there are select pockets where companies are doing well. Third, of course, is you're listening to the deleveraging story that is happening in some of the large names like DLF. So all in all, I think if the market delivers, the companies in the real estate space delivers, and the small uptick, the investors will see a cyclical opportunity which is long-term sustainable for the next 3 years and buy into these assets. So, in terms of the next 3-year view, real estate remains one of the most attractive bets to start considering at this given point of time, given the cheap valuations.
All right, we'll leave it at that. Thanks so very much for joining us this morning, Harendra. That's a quick market view coming in there from Elara Capital. Markets are holding on to early morning gains, but very minute at that, just about higher by 0.1% for the Nifty, Sensex and Nifty Bank also marginally higher in trade this morning. Well, we're going to take a short break, but on the other side of this break, we'll speak to Vinkesh Gulati of United Automobiles about the changing dynamics in the two-wheeler space. And as Infosys and TCS kickstart Nifty earnings today, we talk about analyst expectations from IT companies with Girish Pai of Nirmal Bang Institutional Equities.
What is the meaning of this word suspense? Suspense is something very intangible. Say we show somebody getting killed. For me, I'm not interested in a whodunit. The moment the audience knows that this person has done it, and he has to ensure that he doesn't get caught, there is a certain tension in that. I try to give away as much as possible to the audience and still keep enough aces up your sleeve. I don't think any director would be able to say, okay, this is my style. I don't think I can define it.
Watch his exceptional story, Pursuits by Škoda, only on Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Back with Indian Open right here on Bloomberg Quint. It's a steady start now for the Indian markets, about 0.25% higher for the large cap indices. The mid caps and small caps meandering along. Let's wait and watch what happens during the course of the day. But while the markets might be doing what they're doing, there's certainly some churn in the two-wheeler space in India. Be it scooters losing the sheen in the last financial year, or Bajaj clawing its way back to command a bigger market share. The shift through, though, happened over the last few months only. So what did Bajaj do right to make its way back into the game after losing out to newer players like Honda Motorcycles in the recent past? Let's ask someone who runs a Bajaj auto dealership in Gujarat. Vinkesh Gulati, the director of United Automobiles, joins us right now from Ahmedabad. Vinkesh, thanks so much for taking the time out and being with us. We were talking this morning about the two-wheeler space and how one, Bajaj is a clear gainer and Hero and Honda have both lost market share. And the fact that scooters have lost market share, even though mopeds and motorcycles have done well. Let's first talk about that behavior and then we'll come to Bajaj individually. What do you see? Why is it that scooters, which were fancied for such a long time, have lost a bit of market share, and how mopeds as well as motorcycles have retained or gained market share?
Actually, if you see, the scooter market is basically the semi-urban and urban type of a customer. And that is where the sentiments are too low as of now. So if you talk for the past 6-8 months, if you see, all the growth of the economy is not seen. Mutual fund, shares, real estate and all things. Whatever bothers the service class or the semi-urban customer is not practically actually giving returns. So because of that low sentiment, it has got affected to scooters more than the motorcycle. Obviously, motorcycle has also got a bit of degrowth or not a big growth, but the effect on a scooter is being seen more.
Okay. Do you think that that change could continue, Vinkesh?
Yeah, as of now, at least for 2 quarters, I expect that this would continue.
Okay. So for the next 2 quarters, it could continue. Okay. The other, question is that while scooter sales on the absolute basis decline, on a very small base, moped sales have also seen a bit of a pickup. It's a very small bucket, but just wondering, what are your thoughts? How come India is moving back to mopeds?
It's actually not moving back to moped. Moped is a segment which has not been affected because of the downturn in economies and the market sentiment. Those are basically the, you can say, very lower class people who don't want to upgrade to a motorcycle or a scooter. And there the purchase is basically necessity based. They don't buy a vehicle as an aspiration. They buy a vehicle because they need to go from A place to B. And that necessity is still being continued. So we are not able to see the negative negative degrowth in moped as of now. But obviously in long term to go, it will start showing if the market doesn't come back to normal.
Vinkesh, just talk a little bit more about which particular brands or segments, particularly for Bajaj Auto, have done well in the recent few months, and what has been the main cause, the reason for that pickup that we are seeing? Has there been more discounts being doled out from dealers?
So practically, if you see what has happened to Bajaj, Bajaj was never an aggressive player in the market. They were always working on having a niche market of pulsars and product like Avengers and high range of Discovers. From the festive season last year, they have started becoming aggressive with the launch of that insurance scheme of 5+ for 555 scheme. And because of that, that was the first time when Bajaj became aggressive. and that has helped us in increasing the retails and gaining the market share. Whereas the other company didn't respond after that insurance fiasco which happened to the two-wheeler segment. So that is where we benefited, and actually the benefit came from the sale growth of CT100 and the Platina market growing big. Now the CT100 price is actually equivalent to, you can talk of moped. So that is where we could see some growth. So overall segment is not growing, but in the segment, Bajaj, because of its aggressive discounts and the dealer being pushing the market so much, we are able to see a better market share in Bajaj.
Particularly with regards to the segment that you spoke about, that was CT100, the idea was that probably offer the kind of lucrative prices to gain a lot of market share vis-a-vis competition. Is that something that's actually becoming a reality? Are you seeing that within the segment, that Bajaj Auto is pipping over competition?
Yeah, actually, there is an effect. I'm not saying it's a major effect, but there is an effect because that segment now Bajaj has a bigger market share as before, and the pricing and the discounting has helped us a lot in that. And I feel that the current upgrades what are happening, if you compare the 125cc and below, you will find not a major increase because of this 1st April edition of the brakes and all that. And above 125cc, the price is more. So I feel the current play or the increase in market, whatever will happen, we'll see a positive thing in below 125cc, which is where CT and Platina is working today.
Okay. The concern over the last few months was that the inventory levels were exceedingly high for not just the four-wheelers, but even the two-wheelers. Is that churn happening at a faster pace now?
So it depends on OEM to OEM. There are some OEMs who have improved a lot. There are some OEMs who are still struggling. They still have a pressure on billing, so not very good. I'll not say that average inventory has improved to a level where a dealer should be happy. But yes, there are OEMs like HMSI who have improved, taken a 40% production cut in March, and their dealers have come down to a level of 25 to 35 days. But the rest of the OEMs still are struggling.
So, if you were to probably, give us a ballpark in terms of what the number of days of inventory held are looking like for now, from the earlier 55, 60 days, what would it be?
So it's now on an average of 45 days.
Okay, so it's come off a bit.
Yeah, it's come off, but it's come off with only one or two OEMs, not all.
Okay. I just have a follow-up, Devina. When we were speaking to the FADA guys a month ago or something like that, Vinkesh, the conversation was that until the inventory days come off meaningfully, the primary sales will see an impact. Would you reckon that would be the case even for the months of April and May, that at 45 days inventory, the off-take or the offloading from the warehouses to the dealers from the manufacturers would be slow?
I'm expecting. See, the Q1 of last year was very, very good. And the current trend of the retails are not showing. The Navratri and the marriage season, we have a good inquiry pool, but still the conversions are low. So I feel the wholesale or the data you are suggesting to, I am expecting it will not be that great.
You mentioned that the inventory levels have come off for a few OEMs in the market. Could you tell us which ones?
So obviously HMSI is better, TVS has improved. The rest of them come down a bit, but not as expected and not as convenient for dealers.
Do you see any material change in, probably a bring down of these inventory levels or a pickup in sales for two-wheelers in a meaningful way in the coming few months? And what could be a big game changer right now from the current scheme of things that you are in?
So obviously from March we'll see a good increase in April. The retails will be better in April, May as compared to the February, March. But it won't be better than year-on-year figures. So we are expecting, because Navratri is there and the festive season is coming over, the marriage season is coming over. So we are expecting a better growth there, but not year on year. On month, yes, I'm expecting a growth.
We have a forecast for weak monsoons as well. Is that going to be a big deterrent?
See, a monsoon's effect comes after, you say, the coming festive season. The April and May month won't be affected so much because of the monsoon. So yes, I see if the monsoon is weak, the year would be, it's already a challenging year that will become more challenging for the dealers in the market.
Okay. Vinkesh, final question from my end, and that's on insurance. Now, the opinion is divided as to whether insurance really hampered the growth, or was it only the higher petrol bill on the tank that impacted? What's your sense, and what's the situation currently?
See, actually, when the insurance prices went up, the confusion was because of the guidelines set by the court and the IRDA and the drilling down to the actual customer. So I'll say the insurance triggered the problem, but that was not the only problem. Once the insurance triggered the problem, then everything came back. So that was the major issue, because a two-wheeler increased the insurance basic by 5,000 to 6,000. No doubt it settled down to an increase of 2,000 to 3,000 as of today, but it has still increased. The customer has the mindset that a vehicle has gone costlier to buy now because of all those media hypes and the problems we had for a month where we couldn't find the insurance company giving the exact scheme of 5+5 and then the compulsory accident insurance and all that. So the main reason for triggering this problem is insurance. Yes, but there are a lot of other things which hampered the overall market sentiments.
Okay. Vinkesh, we'll leave it at that. Thank you so very much for joining us this morning. Great to get a perspective from you on the on-ground realities of the two-wheeler space. Moving on then, it's a big day. In post-market hours, you'll have two big heavyweights reporting numbers from two-wheelers to IT, and earnings today for both TCS and Infosys are expected to be reported today. Growth in their revenue figures, with both bagging new orders, but what may not impress analysts are the margin numbers. Joining us now to talk about the sector as a whole and individual companies is Girish Pai, co-head of equity research at Nirmal Institutional Equities. Girish, thanks very much for joining in. So I'm looking at your report, and the scales are more tilted in favor of Infosys and TCS.
Yeah, in the near term, yes. So I think that FY20 we'll probably see Infosys nose ahead of TCS from a growth perspective. So if you look at FY19, TCS delivered double-digit constant currency growth. Infosys probably delivered high single-digit kind of constant currency growth. I think that TCS will decelerate a bit, in the sense that it's going to come back down to single-digit growth. And so I think it's all dependent on what kind of a large deal total contract value TCS is able to deliver in Q4. So the previous Q4 of FY18, they had some very large deal wins. I think they've not given the number in the public domain, but my sense it's probably upwards of 7 billion. Look at the last 3 quarters, TCS has delivered about $5.5 billion kind of a TCV number. So Q4 was a very large number, and they had already stated that almost 250 basis points growth that they saw in FY19 was because of those large deal wins. So unless you get a number which is better than the number one saw in TCV in Q4 of FY18, delivering double-digit growth in FY20 could be a bit of an issue. Though the management commentary seems to be fairly positive, they're saying that double-digit momentum will continue. So we need to watch for the kind of TCV number that they talk about in Q4. So that is a bit of a question mark. So if you take that out, I would think that the large deal wins of Infosys have been very good in the last 3 quarters. 9 months number is almost double that of the previous 9-month number. So there's a potential for acceleration in growth, modest acceleration. I'm talking 150, 200 basis point acceleration happening for Infosys compared to TCS. So Infosys will probably nose ahead of TCS, and I think that will probably lead to a little bit of discount compression from a P multiple perspective. It's already happened a bit. I think it can happen a little bit more.
Do you see further strain on margins this time around? Last quarter as well, it was the human...
Right. So TCS surprisingly delivered some negative margin numbers. Negative means the surprise was on the negative side for TCS because they recruited a lot more people. They took on a lot more subcontractor costs because I think they were preparing for the kind of business that was kind of coming through. And there's been a problem in the US in terms of getting quality talent, especially in the digital services side with all the H1B related problems out there. So I think they're trying to lock up talent in the US, and that probably led to higher costs in Q3. I think that the margin of about 25, mid 25 will probably continue into Q4 of FY 19. I would think that TCS probably has a better chance of maintaining those 25% kind of margins even in FY 20, whereas I think there could be a slippage of margins for Infosys going into the next year. For various reasons. I think the primary could be because of the large deal wins that one has seen in FY 19. I think some of them will require investments. Some of them will be in transition phase. There's going to be rebadging of employees. So I would think that combined with localization related investment, sales related investment. So all those in my opinion are going to lead to a 100 basis point cut from a margin band perspective for Infosys vis-a-vis FY 19. Whereas growth could probably be a little ahead of TCS. So that's the kind of broad picture I see for both these companies for FY 20.
What's the, I think your report also says an interesting bit about how the focus of the market would be on the pockets of weakness and the potential for recovery in the same. Now, when we look at the belief, Girish, that the larger part of the market had for better part of FY19 was that growth is slowing down, but it got pushed quarter by quarter further down the road, and therefore it probably didn't impact the earnings of a lot of firms, not just software firms, a lot of firms. This time around, if the words are to be believed, we are in the midst of a slowdown. Do you think commentary from world banks and some of the key clients of all of these IT companies worldwide will start showing, and that will impact sentiment first and then earnings delivery later on?
Yeah, that's my base case. So I do think that growth kind of coming off from about 3% levels in real GDP growth for US for 2018, probably coming down to 2 to 2.5% in 2019. Plus almost a recessionary kind of situation in Europe and Chinese growth kind of coming off, which has an impact on S&P 500 companies because they've got a very large exposure to China. So I think all of these, in my opinion, is going to lead to slower spending by the customer companies, which will impact total contract value that get accreted by these companies over a period of time. I'm not saying it's going to happen in Q4 of FY19. I think going forward, that will get reflected. See, one of the things I want to disabuse you of is this whole thing that when you have a TCV number, that will automatically get translated into revenue. That need not happen. So if you have a situation where customers feel pain, they need not ramp up their projects. And this is like a capital goods company. We've seen in the past where BHEL, you have a very large order book, a decent chunk of it is not translating into revenue because the customers are not willing to spend. So we've seen in the past when there are pockets of weakness in terms of macroeconomic situation, customers kind of hold back in terms of spending. So a TCV number is very nice on paper, but it may not translate into revenue growth. The other thing that I think the market is not focused on is the kind of compression one is seeing in the larger existing book of business. So we talk about the new business, which is TCV, which keeps coming in. The old business keeps contracting because there are productivity gains that these vendors have to give to their customers on a yearly basis, and there is automation related kind of compression that's happening. So all those things, in my opinion, on the larger part of the business, there is a compression happening. So if I'm a little bit more cautious on my growth expectations, not so much on FY20, but more on FY21, these are some of the factors.
Okay, because I was going to ask you, then what explains what Accenture did?
Accenture is I think it's in a slightly different league, in my opinion, on a very large base of $42 billion. What is moving the needle for Accenture are 2-3 areas where Indian companies are not really focused on. So the big driver of growth for Accenture has been Accenture Interactive. So they are eating into the CMO budgets, the marketing budgets. So these used to typically go to a media agency in the past. Now that's all going to the digital marketing arms of some of these companies like Accenture, even a Cognizant, for instance. So if you look at the last 5-6 years, a lot of the incremental growth for Accenture actually come from Accenture Interactive. It's about an $8.5 billion
so they're targeting 2 budget pools.
So you are actually tapping into other budget spend pools of the customer, which Indian companies have not been looking at.
HCL Tech is not doing that? I thought they're doing that.
No, I don't think they're doing that in as material a way like Accenture is doing. So $8.5 billion number for Accenture Interactive is a very sizable number. I think in the security services side, it's almost like a $2.5 billion number. I think the security services business of Indian IT services firms are fairly small right now. So these are areas which are price insensitive as we speak right now, and these have been the areas which have been growing for Accenture. So it's a different story for Accenture. I do think that Indian companies are going to do well in FY20, but I think broadly in the price, if I look at the PE multiples of some of these stocks, they're trading at a standard deviation above the 10-year mean. So I think some of the good news in FY20 is in the price. What is probably not in the price is what may look what I feel could be a potential significant slowdown in FY21 in terms of revenue growth. So I'm looking at almost like a 0% industry growth, whereas I think my peers in the industry on the sell side are looking at something like 9-10% kind of growth.
Big dichotomy.
Yeah, it's a big dichotomy because I think that in the best year you've delivered an industry-wide, we've delivered organic growth of say 7-8%. I would think, and that is when macro conditions have been the best, which is what we've seen in FY19 or 2018. If you see US grow at say 1.5% in 2020, I would think that growth is going to kind of come off. So that's my call. It's not a call based on a recessionary situation in the US. It's a call based on soft landing in the US. We're not talking about negative growth there. We're talking of 3% going to a 1.5% in the US in one sense.
So then these are big markets for both Infosys and TCS. North America as a market. So that could take us in a severe beating. And what does it do in terms of, so while we have a total contract value, in the near term, the size of orders that they get. So you have your brackets of big orders that you get in and your big contracts that come in. Do you see that scale down happening in the quantum of not just the number of big ticket orders you get, but just the fact that that big ticket order will no longer be a big ticket order. You'll come down to a smaller spend.
No, what I'm talking about is, you have these big ticket orders. They are very nice to have on paper. Whether they'll actually translate into a ramp up of deals into revenue growth is something that one needs to watch. And especially,
I understood that. I'm talking about in the future.
I think there could be spend related issues. Probably it's very difficult call to say, whether those large deals are going to be split up into small size deals. You do go through these cyclical situations in the industry where sometimes these are split into smaller deals, sometimes they kind of aggregated into larger deals and stuff like that. So we've seen the situation in the past where these things happen on a cyclical basis. So I wouldn't say anything specific about this. I'm basically saying that spend growth is going to kind of come off going into the next 12 months. I think already healthy FY20 is kind of factored in. So that's why we're kind of a little cautious on the sector. So we're not saying that IT services is a doomsday situation. We are basically saying from a portfolio perspective, we should be underweight the sector vis-a-vis the benchmark weight that IT has got. And within the sector, we kind of, while we have an absolute downside for all stocks, except for HCL Tech, we would prefer a TCS, Infosys and HCL Tech in that perspective from a 12 to 24-month perspective.
So what would you attribute this current move on the IT index to? An anticipation of the earnings? You think they've baked it in? Because it's really interesting to see that the currency has trended the way it has, yet IT as a pocket has remained resilient.
Yeah, so I think market is betting on something positive coming through in the numbers. So unless TC, there is in TCS for instance, I think market is a little skeptical about double-digit growth, just as I am. If they come out and give us specific guidance that they'll actually see double-digit growth, there is a potential for TCS to run up another 5%. Similarly, for Infosys, there is a concern on margins. If Infosys comes out and says that margins will not dip, they will probably remain in that 22 to 24% band, and you will probably see high single-digit kind of growth. Yes, there is another potential for a 5% kind of an upside. But I'm looking at beyond that. So interestingly, you picked up INR. I think INR, very interestingly, last 5 years, we did this exercise, has depreciated by just 2.8%. In UPA2 era, it depreciated by 5.5%. On an annual basis. Now, when you compound that, that is a very big tailwind for Indian IT services firms, whereas it's just 2.8% because inflation has been down. Inflation in the UPA 2 era was 10%. It's down to about 4.3%. That's what my economist tells me. So if the relative inflation is lower in India, then I think that's not very great news for IT services firms because rupee will not depreciate at a faster pace.
We can go on, but time up on the show. But Girish, so good having you. Thank you so much for taking the time out. And let's see which way the die gets cast. Much appreciate you joining in today. Well, we are out of time on this leg of Indian Open completely. The markets are flattish to marginally in the green. It's a wrap on this show. Thanks so much for joining in from Devina and me and the team that put this show together. But stay tuned. The FNO show takes over the action on the other side.